Hello, I'm Andrew Monteith of D&GAM. The close of 2010 turned out to be the end of a very difficult decade for investors in all asset classes. And we at D&GAM saw it as a good point to revisit our research into the asset class of prime central London residential property, hereafter referred to as PCL. The purpose of this research is to examine and understand the long-term trends and characteristics of PCL. We wanted to be able to compare PCL to a variety of different asset classes, and therefore we needed complete data for all of them. This has meant taking as our central 20-year period the years between 1989 and the start of 2010. We set ourselves the task of first of all understanding the interrelationship or correlation between PCL and other asset classes, including UK equities and UK commercial property over this long investment period. And secondly, deconstructing the returns of PCL to better understand them. Clearly there's been fresher data since 2010, and the charts in our research document will be updated continuously. However, we think the research shows certain trends and points to clear conclusions. There is no doubt that from a capital perspective, PCL has been a dominant performer. We began by looking at its capital performance over a 20-year period against a number of well-recognised asset classes. As you can see from this chart, its superior qualities stand out. If you had invested £100,000 at the end of 1989 in each of these asset classes, 20 years later your investment in PCL would be worth £354,000, while your investment in the UK housing market would be worth £264,000. The equivalent sum invested in the FTSE 100 would be worth £223,000. At the same time, the capital value of the IPD All Property Index actually declined. The capital performance of PCL has been outstanding, especially when you add inflation into the equation. In the 20 years to the end of 2009, against a backdrop of an 83% rise in the RPI, PCL capital values rose 254% in nominal terms, whereas commercial property actually fell 2%. For those who say that owning a house in the UK is a good proxy for investing in PCL, we looked at this argument from a number of angles. First of all, we looked at the correlation of regional house prices to PCL. What we found from analysing the data over 5, 10 and 20 years was that over the long term there was only a small correlation between regional house price movements and PCL, and in some regions like Yorkshire, Humberside and Wales the relationship was very weak. Two statistics, however, stand out. The first is that over the past 20 years to the end of 2010, the Savills All PCL Index has significantly outperformed the nationwide index. In fact, when we analysed the long-term chart of PCL, we noted that the starting point of each cycle was significantly higher than the starting point of each previous cycle. We are not denying that PCL doesn't have cycles, but as you can see from this chart, over the past 40 years, investors have soon returned to the safety of PCL bricks and mortar. What of risk, particularly at a time of ever-increasing volatility in other asset classes, notably equities? Our analysis has shown that PCL has a good risk profile against other asset classes. We looked at the annual average total returns of equities, gilts and commercial property against PCL and plotted their performance against the commonly accepted measure of risk, standard deviation. What we found was that PCL offered better returns than equities and commercial property, while at the same time offering investors lower risk. As you would expect, gilts were the least risky asset, but at a cost of performance. Another consideration for investors in PCL is its diversification benefits from other asset classes. For many investors, there is little point in owning a particular asset if it moves in tandem with other asset classes. When we looked at the correlation between PCL, equities, commercial property and gilts, we noted that on a long-term basis, PCL has little correlation with all three alternative asset classes, and the relationship with gilts was, as expected, negative. We also took this analysis further to determine the relationship between the wider UK economy and PCL. This analysis in particular highlighted the difference between the performance of PCL and UK commercial property. Taking two important indicators of UK PLC, UK GDP and the UK equity market, we looked at the correlation of PCL and commercial property next to one another. These two charts clearly show that UK commercial property holds a much closer correlation to the fortunes of the wider UK economy than PCL, indicating that the buyers of PCL are not dependent upon the UK economy for their wealth, which is another way of saying that PCL is a good domestic play on international growth.